Welcome, Michael. Today, I'd like to find out a little bit more about you and then hear you talk about audit because you have deep knowledge and great passion. So before we dive into the technical content, the first question is, what is your favorite restaurant in Kenya?
Well, I know you're saying Kenya because that's where I am from, originally from. I would say, I wouldn't use the word restaurant, it's sort of a joint. So I would say my favorite joints are where you go and have what we call nyama choma. Sort of a barbecue. Here you sort of use the word barbecue, but for us we use the word nyama choma. And this is where you go, you actually select a live goat, a goat that is alive. You literally pick one out of many, and then you ask them to slaughter that one. And you can actually watch as they slaughter. You can literally participate. You can actually take the knife and actually slaughter the goat if you want.
That's very different to an Australian way of going to the restaurant.
Yes.
Okay, yeah. Wow. And how many people would do that?
You generally have your friends with you, so maybe around 10, 15 people. Mm-hmm. Yeah, so the more the merrier.
Okay.
Yes.
Well, that's a very different way of doing life for sure.
Yeah.
Thanks for sharing that. You've got an interesting background as well from the accounting world because you've worked Big Four and corporate.
Yes.
Tell me more.
Yeah, so I started my career at EY. Back then we used to use the name Ernst & Young. So I was with them for 5 years, and then I felt I wanted to explore the world. And so I applied to KPMG Australia, and I was fortunate to get a role here as an assistant manager. So I was with them for quite a while. Mm-hmm. It was very, very exciting time for me, did a lot of audits. Some of them are listed obviously at the Australian Securities Exchange. So I really got that very good knowledge that I was after. And then after that, an opportunity came up at Rio Tinto. They wanted someone to look after risk and audit for one of their businesses. And I put my hand up, I applied, and I got the role.
Yeah.
So I was there for quite a number of years. I also did while with Rio Tinto, I did an expatriate role in Mozambique, which was another exciting thing in my career. Love that. And then I worked for SICK as a group audit manager after that. Then here I am at Knowledge Equity.
Teaching the CPA program. Well, what I really like to hear about that, we often read about auditors, they often don't have many good things said about them, but you've worked this. And when we read, for example, in Ethics and Governance, Module 2, it talks about the theory of code of ethics and different types of threats. You're actually lived and breathed that. You've been an auditor that's gone and worked corporate, which creates its own issues. And you've seen audit from the inside. My question, we talk about poor quality audits. It's a thing that really harms the credibility of the accounting profession. And some people think the auditors, they mustn't be very good. And my personal belief is I think the auditors are very good. They're well trained, they have great systems, but they deliberately, whether they mean it or not, do poor quality audits. What's your thought on this and what's your personal experience?
I totally agree with you. The training is very robust. It's very thorough. I obviously worked for EY and KPMG, and I saw that firsthand. You get to really understand the ethical principles, the threats to these principles, and you really get to know what safeguards to put in place. So the problem is normally not that the auditors don't know what they're doing. It's normally that they are conflicted. Yeah. So especially if maybe they're getting a lot of revenue from a particular client, there's a fear of losing that client.
Yeah.
And all that. That's where the issue comes up.
So there's the fear of losing the client, so that's your revenue from that contract. But then I also think there's an extra layer of conflict when we have these non-audit services. So you have to do a good audit so then you can sell some tax advice, some computer IT advice. Is that something you saw as well?
Yes. Because let's face it, it's an audit firm. They want to maximize their revenue. And so audit is just one piece of work that they do there, but they generally tend to want to do some tax work, some consultancy work, internal controls work, and all that. Yeah. The problem is the more you do, you start getting into this gray area where you sometimes could even potentially review your own work. And so it can get quite
It gets very complicated. I can see that. So when we look at the theory, we talk about accountants acting in the public interest. But who inside these big firms, you worked for 2 of the Big Four, are there many advocates in there saying, hang on, people, be careful, we have to put the public interest first? Or do you find from the management or partner level, the pressure is on to sell?
To be honest, from my experience, there was that be careful. Mm-hmm. I mean, that the tone at the top was really good.
Yeah.
I think the partners did their work and all that. I just think like sometimes there's just 1 or 2 or 3 things that happen, or maybe that conflict. That's where the issue comes up. But generally for all the audits I was engaged in, I never ever felt that the partner was conflicted. So I would say when it happens, it obviously, escalates and explodes. But generally, I would say 90% of the work they do is normally done in a very systematic, thorough way.
So we've looked at the auditing conflict, we've looked at some other areas, but if someone is studying audit, we want to get beyond just, I always say, oh, you're an auditor, or you'd go and do an audit. Now, when you hear those words, you know that that's not technically the right description. What do you want to say when someone says, oh, you're an auditor? What do you say?
Well, if it's out there in the streets, don't have a problem with that, because people just tend to use the word auditor to refer to any assurance practitioner. If someone is, however, doing AAA, Advanced Audit and Assurance, they need to be very careful about these terms. It makes a big difference on whether you pass or not. So, for example, an auditor is just someone who looks at historical financial information. The broader term we use is an assurance practitioner. So, in a nutshell, an auditor is an assurance practitioner, but not all assurance practitioners are auditors. So just be careful about that. That's what I tell candidates.
All right. So it's important to learn the words, what they really mean. So the next thing I'm going to talk to you about is we hear about engagements. There are direct engagements. There are attestation engagements. Normally, I've worked in business and I say, oh, the auditors are coming. We have an audit coming. I don't think I've ever in my life said, I have an attestation engagement about to occur. So what is the role of the auditor in these two engagements? What is the difference between these two engagements?
Yeah, and it's very, very important to understand this, because this is part of the assurance engagement framework. And if you don't understand this, obviously, as a candidate, then you will struggle with the other modules. So going back to your question, what is an attestation engagement? So an attestation engagement is an engagement where another party, other than the assurance practitioner, compares the financial information or the subject information against the criteria. Now, I'm sure you're hearing a lot of technical terms, but this is exactly what Advanced Audit and Assurance is, It really prepares someone to be very technical. So going back to that, so there is a party who compares the subject information against a criteria, and then the auditor comes and looks at that work that the other party has done. And if the auditor is happy with that, then they will provide or issue a positive opinion. If they're not happy with that, then the opinion will obviously be adverse or negative.
So the auditor is double checking the work, not doing the work.
Exactly.
Okay.
Exactly.
All right. That helps.
Yeah.
All right. And so if you were going to say direct engagement, attestation, how's the easiest way to remember the difference?
So direct engagement is actually quite easy, because all you're saying is, and I like the term direct, you can actually use that to remember what it means. It's the assurance practitioner directly compares the subject information against the criteria. Therefore, if you know that, then you know an attestation engagement, there is another party who does that.
All right.
So that's the easiest way to remember that.
So a direct engagement, I directly did the work myself, and attestation is I am attesting that someone else has done this work very well.
Correct.
Okay. It's starting to sink in, but if you asked me in a week's time, I might have forgotten. So what we have now is another party. So you've talked about attesting someone else's work. Who is that someone else?
A very good question. Normally it is management. And I'll explain this a bit. So what tends to happen, and let's go into say the audit of historical financial information. So you'd obviously have the auditor, and then you'd have management. Now, what is the subject matter information? I've been talking about the subject matter information. Very simple. It's the financial statements. Now, what's the criteria? Again, very simple. It's the IFRS. And so what tends to happen in an audit is management will prepare the financial statements. But as they're preparing the financial statements, they will be making sure that these financial statements comply with the criteria, which is the IFRS standards.
So you have to follow the accounting standards. That's the criteria for determining if you've accounted for it properly or not. You've
100%.
cheated or you've not. You've manipulated or not. All right.
Yes.
So the auditors have to know these standards inside out.
Yes, correct.
All right.
Yes.
So this brings me to another ethical kind of area, right? And it's called the expectations gap. I think that's what I call it. I hope you know that. So what happens is people expect the auditors to come in and do a good job. If they say you've passed the audit, you get a tick, you can trust these numbers. But then normally what happens is whenever an audit is, let's say, poor quality or a company goes bust, the first thing the auditor says, it's not my fault, it's not my job to check anything, it's the management's fault. we just checked their work and they didn't do good work. And to me, that just sounds like making excuses. What's your thoughts?
Well, I've been an auditor, so I guess I can say this, that auditors tend to look at materiality. And so this is a threshold by which once it's hit, an investor or a decision maker can make a different decision, depending on what they see. So let's say if the auditor decides that the materiality is $1 million, that means that if there is an error more than $1 million, they believe an investor might decide not to invest in that company or potentially make a different decision. Okay. And so the auditor always audits against that materiality. Now, what tends to happen is they tend to sometimes not care so much about things that are lower than that. And so what you will find is when a company goes bust, sometimes it could be because of this, or it could be because of things that the auditor did not see. Now, a lot of times, I agree with you, the auditors should have seen something. Most of the time when a company is going bust, it's because the errors were actually material. So a lot of the companies that have gone bust, that's actually has been the case, that the issues were material, but the auditors did not detect. So they have a point when they say you should have seen this as an auditor.
And I think I would like a little bit more honesty. Sometimes an organization can go bust just through, not everyone's corrupt or dishonest or whatever. You might just be in business and you trade and you just cannot make a profit and the economy turns. Totally understand that. But it sort of seems that the auditors they should be ringing the bell a little bit louder. But I think they're too scared to, because this is the paying client. They don't want to be known as the auditors that ring the bell. No one else will ever hire them. Have you ever felt that pressure or seen that pressure?
Yeah, and the reason for that is exactly what you've said. Who pays the bill?
Yeah.
It's the management, or it's the owners of the company. And so the auditor has that fear that, if I am actually completely honest and say this company looks like it will go bust in another 12 months, then obviously there is a fear that the auditor will lose that client. And it's that conflict that we've been talking about when we started this that actually messes up everything. It's when the auditor is fearful, it's when there is a bias, it's when there is a threat to those fundamental principles.
And for me, and this is a conversation for a different day, I think that there is a structural problem there. We will never fix that problem. We have to do it differently. But we'll talk about that a different time.
Yes.
But so coming in on this, so another frustration I have, here is me venting on auditors, and it's lovely to have an auditor in the room to do this too. When we talk about good quality, we say something's qualified, someone's excellent. If you're qualified, you've done the training. But in audit, you use the word qualified back to front. Why do you make things so difficult in audit? Why do you use such complicated terminology? And that confuses people. Because you have qualified audits and unqualified. Can you explain those for a moment?
Yeah, it's interesting, and I guess it's like every profession. There are all these technical terms. I mean, if you deal with an engineer, you kind of go, "What are you talking about?" You deal with a computer scientist, the same thing. It's the same with audit. It is a profession, and so yes. So many times when the auditor says, "I've provided or issued a qualified opinion," that actually means it's not good.
Yeah,
that means that there are
it's
issues
back to front.
Yes, exactly.
They should say, "I'm issuing a negative opinion, a red flag opinion, you are terrible opinion," not a qualified opinion. It sounds like you're qualified to do the job. Well, I'm glad you're qualified. And then unqualified is negative. Hey, this doctor did an operation and cut the wrong leg off because they're unqualified.
Yes.
So then you give an unqualified report, and that is good.
Yes. So an unqualified opinion is actually a clean bill of health. You're actually saying, I've looked at the financial statements and everything appears to be okay.
Okay.
Yes.
I've got to tell you, that hurts my head. But we'll leave that be for now. So all audits are attestation engagement. So that's the one where you're checking someone else's work and giving an opinion. Now we're checking, let's say the management, they've prepared an income statement and balance sheet against the standards, the accounting standards, some simple ones like property, plant and equipment, great. Have assets been impaired? Have the liabilities been recognised properly? But, okay, I get that as a concept, but can you practically explain how this works in an audit? What do you do?
Yes. So maybe what I want to start with is, when you talk about attestation engagements, you are saying that there is another party other than the auditor comparing the subject information against the criteria. So this is a very important statement. All audits of historical financial information are attestation engagements. Okay. Yeah, because the auditor is not permitted by the standards to actually compare the financial statements against the criteria. That's the work of management. And so that independence needs to be there. Yeah, I remember when I started working as an auditor, and we had these small clients, and you could see this owner of the business doesn't even know how to prepare financial statements. And sometimes you kind of want to guide them, but you know that by doing that, you could actually get conflicted, because now you start getting into reviewing your own work.
Okay, so I would call that a financial statement compilation. Yes. Where you actually prepare the account. So the auditor is actually prohibited from preparing
100%.
All right, but I have seen, I've worked in a lot of small businesses, and their accounts are terrible. I would love it if accountants or auditors came in and said, you're doing it rubbish, let's just do it right from the start. Wouldn't that help solve the problem?
That's a good point. Now, what would happen then? The auditor needs to decide whether they will prepare the financial statements or audit whoever will prepare the financial statements. But they can't prepare the financial statements against the criteria or making sure it complies and then audit their own work.
I get that, because you'd have a conflict. But I would like these auditors are being trained. They know the standards really well. They're doing it all day, every day. Far better than management of a small business who have no idea about accounting.
Yeah, that's correct. And that's why you find sometimes two different firms can actually do this work. So one firm, one accounting firm can actually prepare the financial statements, compare it to IFRS, and then another audit firm now looks at that work.
And in your background, did you ever work on compilations rather than audits?
Yes.
Oh, okay,
yes,
so it is a thing.
Yeah, and that was mostly with small clients. Yeah. And then what would happen is then we would have, say, a PwC or a Deloitte now performing the actual audit and giving an opinion on that.
All right.
Yes.
So thank you. And I interrupted you. So tell me back again, how does an audit work? An attestation engagement?
Yes. So going back to that, so all audits of historical financial statements are attestation engagements, and the reason, like we've said, is auditors are not allowed to prepare the financial statements. They're not allowed to compare the financial statements against the criteria. They're only allowed to provide an opinion on what management has done. Now, management can hire another party to do that. Management can hire someone to do the financial statements and compare with the criteria, but the auditor's role is just to look at this. When it comes to direct engagements, however, the assurance practitioner, not how I have moved from auditor to assurance practitioner, the assurance practitioner can actually do that work. So they can actually compare the subject matter information against the criteria. What is even more interesting is in a direct engagement, the subject matter information can also prepare the criteria. So what you'll find is sometimes it might be greenhouse gas statements or an area that has never been explored before. There is no criteria that exists. And so you will find that the auditor can, or rather the assurance practitioner, can actually prepare the criteria and then compare the subject matter information against the criteria. I love how this sounds. Very technical,
It's definitely very technical. So this sounds good. So tell me about suitable criteria.
So suitable criteria, in every engagement, there is a yardstick, there is a plumb line. And so when it comes to financial statements, it's very easy. It's the, like we said, it's the IFRS standards. So this is established. This has been used over a long time. The auditor doesn't need to think about what the criteria is going to be when they are doing the audit of historical financial information. However, when they are doing the review or other assurance engagements, they need to consider what the criteria will be. Like I said, sometimes they may have to prepare it, but if it exists, then they can use it. So if, for example, you're looking at KPIs, so the question is, okay, so you're looking at an organization, how has it performed? What's going to be your criteria? And so the auditor needs to think, does something exist? Do the directors have a criteria that exists that they can compare the organization's performance against?
So you could have ASX listed companies, you could have benchmarks, you could have industry statistics about profit or debt levels, things like that.
100%. And that can be used as a criteria.
Okay.
Yes.
All right. So one thing, and once again, you might feel like I'm a bit aggressive towards auditors, but there's things that annoy me because I see organizations do things wrong and no one seems to be ringing the bell. So policy choice. Okay, we're comparing against the suitable criteria. We have an IFRS policy and we have the accounts. But sometimes people choose the policy not to present the most useful information, but to hide the most useful information, to dress it up, to pretend. And a good example. companies capitalize labor costs. They call it development, research and development, or they call it, they built an asset, maybe some software development. And then they call that an asset, but it's really an expense.
Yes.
And they have inflated their profits because they haven't properly expensed. Now, I don't think you can magically create an asset like that. I know that IFRS allow it, but what do the auditors do? When you see something like that, you can say, here is the financials. It matches what is allowed in the standard. Do you sign that off, or do you wave a flag and say this is rubbish?
When it comes to, once you see that, normally what would happen is the auditor would have a discussion with management or with the directors and say, hey, I know you're doing this. I know it's actually allowed by the standards, but it doesn't accurately reflect the state of affairs of the business, or doesn't accurately give that information to investors on what is happening. But unfortunately, like you know, the auditor's hands are tied. If it complies with the standards, then it's sort of allowed, even though it might not be the best representation of actually what is happening on the ground.
And I think the biggest issue there, we have this idea of qualified, unqualified. You get a tick or a cross. But I think it's more of a grade, a shade. Like, you're either 100% compliant and 100% accurate, right? You've done everything you possibly can, the best you can. But you might not be zero, but you might be only at 60%.
Yes.
You've been very creative. You haven't broken the rules, but you are pushing the boundaries.
Yes.
We see it with football teams all the time. Some teams are a little bit rougher, a little bit more, they take advantage of the grey areas of the rules.
Yeah, and you will find in audit that happens quite a bit. So what tends to happen is the auditors, they will sort of give potentially a clean bill of health, which is an unqualified opinion, but they have this letter which they refer to as a management letter.
Yeah.
And it's in this letter that they say, hang on, we saw this and this and this. We didn't quite like it, but we sort of permitted you to continue with that practice, or with that how you've adopted that policy, but it's not ideal. So it's very interesting, and I would sort of encourage people, if you work for an organization, ask for the management letter, see what are the issues that the auditors were kind of weighing and thinking, potentially this is not right.
And I've been involved with management who have received those management letters, and often I'll say, yes, the auditor is right here, or actually they're wrong. They might argue with how I've dealt with debtors and bad debts estimate, or they might say, you need to do this or that. And sometimes, you need a new property valuation. And sometimes I'll say, that would be nice, but it's expensive and it's of limited value to me because I already know what the property's worth. So it can be tricky. I think my frustration with that is that that's not public.
Yes.
So I can easily just put that in the bottom drawer and go, thank you, auditors. Here's your bill. Now go away.
Yes.
So,
and that's
how do we fix that?
That's exactly what happens with many organizations. I must, however, say I've worked for quite a number of listed entities like SICK and all that, and I've also been part of the audit and risk committee. So I've actually attended those meetings, and I can tell you for sure, is a lot of these boards actually chase after and making sure that the management close out these issues. So if you're working for an ethical organization and the tone at the top is actually quite good, then you will find that the audit committee will still chase up on the management letter issues, on the deficiencies that have been noted. And sometimes the auditors also raise business improvement opportunities. So this is also very different. It's not a deficiency. It's not an area of weakness. It's more like, if you could do this, this would improve this.
And I see that linking very nicely to the non-audit services you might be thinking of selling. Yes.
And maybe that's why they actually raise them, so that the management can say, you know what, we could actually advise on this if you gave us that particular service.
Okay. So I guess I'm always trying to fix how do we make this better. My feeling on that then is, if an organization wants to do better, they will actually value that management letter, and they will, and I personally have done this. I've actually, for a school I worked with and helped organize an auditor to come in and check and test, and we wanted to listen very carefully because I was confident we'd done well, but we wanted to do better. So I think an audit with ethical management who are pushing hard to do the right thing is a great combination. But my fear is, when an organization is being a bit sneaky or deceptive, the auditor detects those things but has no avenue to actually flush that out, to get it out in the open.
What you'll find is once the auditor discovers or finds out that an organization isn't very keen on fixing issues, then what they tend to do is actually lower the materiality level when they next go to audit.
Yeah.
So you'll find that it's in the organization's best interest to look proactive and be proactive in fixing issues.
Or you'll dig even deeper.
Yes, because then if they don't, then the auditors dig even deeper and they lower that threshold, which means more is actually looked at.
Yeah.
Yeah.
I think what I'm looking for is more than just a pass-fail. We need to see a clean bill of health is different to you're not going to die tomorrow, but you know, your cholesterol's a bit high and your blood pressure is too high. You need to do something about this, but it's not going to kill you, which is different to, okay, you have stage 4 cancer. Like, I think I would like to see a wider continuum so that people can get a really good feeling. Like if I'm an ASX investor, I'm going to be very frustrated when an organization goes bust 6 months after the audit, because all of these things were noted and raised in the management letter.
Yeah, and unfortunately, you're very right. There's no that early warning system. It's either things are going well or things are bad.
All right.
Yes.
Well, thank you for sharing that. And next time we're going to find more about your favorite restaurants. I'm going to explore a little bit more about what it was like living in Mozambique. And I'm going to see if I can throw some more issues to you that I would love to see a future of auditing where it's held in high esteem rather than ridiculed, because there are thousands of high quality audits, but it's the few bad ones that bring the whole profession into disrepute.
Yeah, I look forward to that. I think that would be very interesting discussing that. Yeah, thank you.
Excellent. Thanks, Michael.
Thank you, Courtney.
Cheers.